If you earn credit card rewards, you may have seen online that credit card rewards are not taxable, except sometimes they are taxable, and the explanations never seem too clear on what the difference actually is. There's limited tax law on this topic, so in this video we're going to outline the actual law that does exist and simplify what it means so you know how to use your rewards without triggering an unexpected tax bill. And if you don't know me, I'm John Mitchell, tax attorney, former IRS appeals officer, and enrolled agent. My day-to-day is running my tax law practice here in Houston, but I create content so you can understand real tax law in plain English. Before we dive into the details, it's important to understand the foundation of tax law. We work with three main levels: 1, Statute 2, Treasury regulations, and 3, court cases. Below those, we also have IRS guidance, such as revenue rulings or announcements, where the IRS interprets the law and gives direction on how to comply. For most tax questions, we have plenty of statute, regulations, and case law. But in this area, rewards, points, miles, actual authority is limited. That creates a bit of a gray area. But limited guidance doesn't mean no guidance. What we do have gives us a clear direction and substantial authority to follow. IRC Section 61A defines gross income as all income from whatever source derived. The Supreme Court expanded this in Commissioner v. Glenshaw Glass, 1955, defining taxable income as undeniable accessions to wealth clearly realized and over which the taxpayer has complete dominion. If we stop right there, you might conclude that all rewards are taxable. For example, if you find $100 on the ground, that's taxable because there's no statutory exclusion, but rewards are treated differently because the IRS has issued taxpayer-favorable guidance, which is rare. So let's break this down into two categories. 1. Frequent flyer miles, hotel points, promotional rewards, and 2, cashback rewards. Each has different treatment. First, let's look at frequent flyer miles and hotel points. These are considered non-taxable under IRS Announcement 2002-18. The IRS explains that the valuation is unclear, they are earned in one year and used in another, and the dollar amounts are generally too small to justify enforcement. Most importantly, the IRS did not say they are legally non-taxable. They said they are choosing not to enforce taxation because it's administratively burdensome. They also warn that if they ever issue future guidance, it will apply prospectively, meaning they could change course later. One important outlier is Shankar v. Commissioner from 2014, a tax court case involving a taxpayer who received airline points in exchange for opening a bank account and depositing money. The court treated the reward like interest income because it was received for the use of money, not for a purchase. And the taxpayer received a 1099, which is why the IRS knew about it. But that case is narrowly focused on rewards received in exchange for using money, not rewards earned on purchases. So for now, miles and points earned from purchases remain non-taxable. Next, let's look at cashback rewards. The IRS issued a key piece of guidance in Revenue Ruling 7696 involving car rebates. Instead of treating the rebate as income, the IRS ruled it was a reduction to the purchase price, a basis adjustment, meaning the rebate or cashback reduces the item's tax basis. Here's how that applies. In a business purchase, a lower basis means a lower deduction, so the net effect is you're taxed on the cashback indirectly. In a personal purchase, a lower basis is usually irrelevant because personal items aren't deducted or sold at a gain, so the cashback is effectively tax-free. This is the core principle behind cashback rewards. But what about the big case everyone talks about? Anakiv v. Commissioner from 2021. People cite this case as proof that cashback rewards are not taxable. The taxpayers ran huge amounts, millions, through a loop of buying Visa gift cards, money orders, and cycling the money back to earn more rewards. They generated significant net cash after fees. But the reason they won is surprising. The IRS brought the wrong argument. The tax court even said so outright. The IRS abandoned the argument that they should have made the argument based on basis reduction under Revenue Ruling 7696. The court practically spoon-fed the IRS the winning argument but couldn't make it for them. They emphasized multiple times that their holding was based on the unique circumstances of this case. So the big takeaway is, do not rely on Anakiv unless you want to be the test case for IRS enforcement. Next time, the IRS will bring the correct argument and win. So in summary, frequent flyer miles and hotel points earned from purchases are non-taxable for now, which is IRS policy, not statute. But the IRS has not changed its position in 20-plus years. For cashback rewards in business purchases, they are taxable indirectly via reduced deductions, a basis adjustment. In personal purchases, they are not taxable because a basis reduction in a personal item doesn't normally create tax consequences. If you like diving into real tax law, stick around. Real tax education should be understandable and accessible to everyone. And as always, for clear explanations of actual tax law from a tax attorney and enrolled agent, subscribe.